Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair. Recently retired from nearly 50 years of being in the brokerage business in BC, but still very actively involved in the markets. Victor, welcome back to the show.
Well, thank you, Jim. Always a pleasure to talk with you.
Taking an overall look at what's happening right now, what are the significant issues impacting all the markets?
Okay. I think certainly, what the central banks are doing, especially the Fed, that's huge these days. And just, a little while earlier here this morning, the Fed had their regularly scheduled meeting, and everybody and his dog, of course, had guesses as to how that was going to go. And the net of it is markets aren't much changed after all of that. Fiscal stimulus, whether it's coming, or not in the United States, is pretty big. What kind of shape it's going to take, the political machinations that are required to get the votes to back the different packages and that sort of thing. I think that's pretty important to the markets. Tensions between China and the rest of the world are pretty important, and that's really taken a leg higher this week, but not in a military sense. But, the Chinese markets, particularly the tech markets, have just been battered here lately. And, of course, when you look at the American market, the tech stocks are the darlings. The tech stocks actually are carrying the rest of the market higher. When you look at market breadth is so weak. Maybe we can get into that a little, but let's save that, and I'll talk more about that when we get to the talking about stock markets in particular. But yeah, China's been pretty significant. Just to put it this way, we've always known that the tensions between China and the rest of the world, and it's not just China and America, were a tipping point, or could be. And you think about Taiwan, or if they have a reload of what has happened in Hong Kong. China tensions are very important. Anyway, to carry on, inflation or not, transitory or not, I think that's been pretty important, and that impacts everything. How do you value something in a non-inflationary environment compared to how do you value something in an inflationary environment? That's been very important, and certainly, not at the bottom of the list, but COVID. Is it coming back? Is it mutating? Is it we're gonna have more lockdowns or not? So there's a lot of things going on in the world, and certainly I can't, and I don't know that anybody possibly could keep track of everything. But thankfully, in my world, or at least the way I look at markets, I look at price action and just know I can't possibly know all the things that I need to know. So I kind of pay attention to or trade price action more than forming some opinion that, I'm going to be right, about what China's going to do or where inflation's going to go or blah, blah, blah. So I think those are kind of the big picture things. And of course, there's a lot of uncertainty because that's the way the world is. It's uncertain, and, the markets reflect that.
The major U.S. stock markets have had a few minor dips this year, but most seem to look at those dips as buying opportunities. What's your view on that?
Well, they've been right about that. I don't think we've had as much as a 5% correction in the major stock indices since, who knows when. Probably you got to go back to October of last year when we had a pretty good dip just ahead of the Biden election in the United States, and a day or two later, the Pfizer announcement that they had a vaccine. I think the market is very richly priced. We have traditional metrics that we would use and apply to where the stock market is now. You say, yeah, it's richly priced. But we also have a totally new thing in the market, and that is, the Federal Reserve is injecting $120 billion a month into the market, and that changes the landscape. So, with interest rates at zero or lower, real interest rates are negative, where do people put their money? You can either sort of drink the Kool-Aid, as it were, and say, okay, I'm hoping for the best and put your money into the market, or you can sit outside of the market and people on the inside wave at you and say, have fun being poor. There is no alternative, and their fear of missing out and all that sort of thing. The stock market's been on a very powerful trend. I think trying to fade that is tough, and I do try to fade it. I don't just say I know I'm right and take a short position and wait to lose my shirt. I look for opportunities where I think the market shows a sign of weakness and get on it. I mean, picture yourself if you're running a pension fund. Okay, your job is to try to create money or generate profits or whatever from the cash you have on hand that is going to meet the liabilities that the pension fund will have, years in the future. And how do you do that when you look at it and you say, oh my God, these stocks are so richly valued and interest rates are so low? I mean, what do we do? And you can't just throw your hands up and decide to wait. I mean, you got to do something. They've got these bogeys where they've got to be producing whatever the number is, 6-7% a year. And if they don't, then the problem just gets bigger and bigger. So, and then there's career risk, I guess. The safe thing to do is just buy stocks like everybody else, because if the market goes down, you say, well, that's what everybody was doing. So, yeah, it would be tough to be running a pension fund here. I guess you look for different things to do. You try to justify what you're doing. You try to have risk management things in place, and so on. Let me just talk about China for a sec. I mean, going from pension funds to China, but as I was saying, what has happened in China, sort of three big things here recently. I guess they're, depending on which indices you look at, but just kind of take my word for it, generally the big cap tech stocks in China peaked out in February. I mean, everybody remembers, Jack Ma just kind of has disappeared from the scene. It seems as though call it the regulatory environment or the authorities, by any other word, have decided to rein in, the egomaniacs that were, running big tech. Now, there's certainly a group of folks in the Western world that think big tech needs to be reined in as well, but, in our democratic process, maybe it's harder. When you're running an autocracy, you just take the guys out behind the barn, right? But that index is down 30-40% since the February highs. I think the last 3 days. Now, here is something I saw, so I'll repeat it. I haven't truly checked this out, but it looks like in the last 3 days, not including today, there was about $800 billion worth of market cap smoked in the tech sector in China. And the tech sector has dragged down the rest of the market, the broader indices over there. The regulators have also gone after what they call education technology, and that seems to be they want to create a more equal playing field where the rich folks aren't able to let's say educate their children better than the poor folks. That's grossly simple of me to say that, but anyway, there's been the educational technology sector has really been whacked. And then we have the world's largest real estate company, Evergrande, is really in shaky condition, and everybody's heard about all the cities that were built with empty houses and all the leverage that used in the real estate market in China and so on. So we got, let's say, debt problems there. Now, the question, without getting into all the details, is it contagious? And we had a virus that seemed to have come out of China and spread all over the world. Could financial shaking and shivering in China, come out and affect the rest of the world? That's the real question. Could China, in effect, export deflation? There's been folks, and I've been sympathetic to this view, that have thought for years that there was just a huge house of cards constructed in the financial sector in China, and maybe this is the black swan here. Weakness in the stock markets, the Chinese currency wobbled a bit. Clearly, the authorities, to go to that again, will try to keep a lid on it, try to see that there's no the market doesn't just collapse, because they don't want that. But at the same time, it seems that the authorities wanted to call the shots, and wanted to maybe discipline some of the folks that were making zillions in the financial markets, and let everybody know who's in charge. So who knows? But there's been some drama in China, and it may come out and affect the rest of the world. So I think that's a very important thing to be paying attention to here with respect to the stock market right now.
One of the things that came up and it affected the Asian markets overnight was China is cracking down on the private companies that provide education in Hong Kong. I guess they feel that's where all these democratic urges are coming from. Yeah,
I think that's part and parcel of it, Jim. I can't say that I'm a China expert. I mean, I read a lot. I've been reading it. I took some positions in the stock market a day or two ago, thinking that the weakness in China was going to affect other markets. So far, that doesn't seem to be the case. In my blog last week, I showed some charts of the tech market and the broad market in China, kind of as a sign of keep your eye on this. And the thing you're mentioning, what we're calling ed tech or education technology, that's one of the three big things that seem to be. The authorities are just kind of coming in saying to those folks, we're going to change things. We don't like the way you're doing things, and we're going to change it. And, when you're running an autocracy, you don't have to get everybody on side. You just tell them what you're going to do.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, you've been bullish on the U.S. dollar most of this year. Have you changed your mind?
No, I haven't, Jimmy, but and I think I've qualified this before, it's not monolithic. I mean, we have the U.S. dollar index, which if the a basket of currencies create that index, and I think the U.S. dollar could do better against that. One currency that I kind of have my eye on, and I've been trading it a bit, is the Japanese yen. The Japanese yen has basically done nothing but go lower so far this year. Speculators have noticed that, and they've jumped on it, so there's a very large short position in the Japanese yen. And in a classical way, the yen is often seen as a safe haven. So if, for instance, the stock market in the Western world was to start to shiver and shake, maybe worried about what was happening in China, we might see the Japanese yen get a bid, so the yen could rise against the dollar. Another generic safe haven is the U.S. dollar. I mean, when the virus really hit last March of last year, the U.S. dollar soared in the short term, and then it fell for the next several months. So in any kind of an environment where the world is uncertain about things and wants safety, you could have capital flows to the U.S. dollar and the yen. Swiss franc, traditionally also a haven. But something I'd one of the ways I go about trading is I just do admit to myself that I can't possibly know, everything that's going on, or even, the most important things. I may think I know something about a market. So, what that means is I look at what the market is telling me, whether it agrees with my little biases or not, and, that's kind of the way I like to trade. And so far, anyway, certainly since the beginning of June, the U.S. dollar has been trending higher, and it had, as we discussed previously, it had a very important turning point, I think, back on the 6th of January, exactly the day when those folks were storming the Capitol building in Washington, D.C., and the rest of the world was looking on with some level of horror as to what the heck is happening here. And wouldn't you know it, that kind of defined the low we've seen for the last couple of years, I think, in the U.S. dollar. So, kind of a capital haven. If things get a little worrisome, and then relative to Europe, America's just more dynamic. But I put a chart up in my blog last week that showed how the U.S. stock market has just smoked the rest of the world in terms of performance going back, over the last 10 years. And, maybe you can picture that would draw capital net to America. Why invest in Sleepy Hollow when you can put your money in the United States? The market's outperforming your local market. So if there was to be sustained weakness in the U.S. equity markets, and that wasn't matched by weakness in other international markets, you could see some of that capital flow back to wherever it came from. But that's a much longer-term time frame. For my short-term trading, I generally have been trading the U.S. dollar as stronger than the other currencies.
The leading commodity market indicators hit multi-decade lows last March and April. Ever since then, they've been on a scorching rally. Is that going to continue?
The rally has been so strong from last year's lows, and those lows were made, around the time of when COVID was getting all the headlines. I think it was the strongest 12-month rally like ever in the broad commodity baskets, and let's say that going back over the last 50 years or so that we were keeping track of those sort of things. So it was a hell of a rally. I think it's just my being from Missouri kind of attitude thinks that maybe it's got ahead of itself. But I think that's what I think, that it's probably got ahead of itself. I wouldn't be, if you're Johnny come lately and you've been reading that you ought to be into the commodity market and you haven't got in yet, it's probably a little late to jump in. For me as a trader, I like to find situations where, everybody and his dog is bought into the story, and then the story starts to wobble, and I want to be on the short side of it. But I think one of the things that would give me pause is that commodities are dirt cheap relative to stocks. And, I talked about pension funds earlier, and, with what are they going to do with their money? They go, do you buy more stocks here at extraordinarily rich prices, the way they would look at things? Do you put a lot of money into the bond market with interest rates so low? And maybe somebody says, well, hey, how about commodities? So, I could see really that commodities relative to stocks are cheap, and that might put a bid into the commodity market. But for commodities to really have a bid, we would need let's call it either a vibrant economy or economy that, for one reason or another, had some real commodity shortages. Could have shortages because of ESG issues making the supply of commodities hard to come by, or we could have geopolitical issues that kind of broke supply chains, and that would kick up commodity prices. But I don't have a big position on that, or a big opinion on that, and I'm certainly neutral as far as trading is concerned.
Interest rates hit their lowest levels ever last year, but with economies reopening and lots of inflation, how long can interest rates stay low? Yeah,
you're right. Interest rates did hit like their lowest levels since forever, last year. And we're talking about hundreds of years, right? So interest rates rose, but the increase in interest rates basically stopped around March, April, depending on which ones you're looking at. And I think part of the rationale that they were rising is, first of all, they were so low, and it couldn't go any lower, folks were thinking. But there was that thought that if and when the economy reopens, there is going to be demand for stuff, and we've certainly seen that. I mean, everybody knows about supply shortages that put the prices of some stuff up. And in terms of inflation, there's the argument about it's transitory or not or whatever. But people, you don't have to hit them over the head to get them to see that real estate prices are going up all over the place. And I think that kind of increase is just a function of, the dollar's purchasing power has gone down. So, we recognize that there certainly is inflation. It's just not necessarily in some of the things like CPI, although even that's been perking up lately. But something happened, and I'm not going to pretend to you that I know what it was, but the yield on U.S. longer bonds, whether it's 5, 10, or 30 years or whatever, stopped rising back around April and has been falling since then. So that would be generally inconsistent with rising inflation expectations, which we have. Now, I can hear folks would say, well, you got the central bank buying $120 billion worth of paper every month, $80 billion in bonds and $40 billion in mortgages. They own 25% of the TIPS market. They own, huge chunks of the mortgage market and so on. Why wouldn't, the interest rates be going lower? But then there's the other folks out there, the Lacey Hunts, the David Rosenbergs of the world, that are saying, and have been saying, that indeed the inflation that we're seeing generated from supply shortages and so on will be transitory. That is right when they say that. And anyway, the bond market has been going up in price. That means yields have been going down since about the beginning of April. One of the things that's really happened there is that the yield curve has really flattened. So bond yields go back to March or so were way higher than short-term yields, and since then they're less higher than short-term yields. And I think a lot of folks had sort of put on a trade where they were looking for longer-term interest rates to keep rising while the Fed kept their foot on the neck of, short rates. And it may have been a function of positioning where everybody hated the bond markets, and were short. And then when the things started going against them, they grudgingly had to start unwinding their positions. And there's another thing here, you'll see this all over the place, that real interest rates are at all-time lows. Real interest rates being the nominal yield on the paper minus the inflation rate, and you get the real yield. Well, in a way, I think, yeah, so what? I mean, we've got short-term inflation numbers here are really high, so therefore, with not much change in the nominal yield, we're going to have really low real yields. But where do I think interest rates go from here? It's that is the $64 question. Last week I shorted some bond calls when the stock market started to recover from its sell-off of Monday of last week. That was sort of my way of buying the "don't worry, everything's going to be all right" idea. That worked out really well. I'll just sort of take it one trade at a time. I could see, honestly, that, in the next couple of years, which is not my trading time frame, but, you look at things like that you'd think interest rates would be higher. I suppose I could see it makes sense if you can go out and borrow a lot of money here and lock it in at really cheap interest rates. It's probably not a bad thing to do if you can find something useful to do with that money. Chances are, a couple of years from now, the cost of borrowing money would probably be higher. That'd be the way I think.
The Canadian dollar, back when the COVID panic started in March, hit 68 cents and went all the way up to 83 in May, but since then has dropped below 80 cents. What's going on there?
Okay, I mean, I think really this, the Canadian dollar got oversold in the lows of last year, as a lot of currencies did it. As I was saying earlier, the U.S. dollar just went screaming higher as everybody ran for safety. Dump whatever you got and buy U.S. dollars. So that took Canada down to 68 cents. And then Canada actually had this kind of a plodding rally higher. You know, it wasn't flying up and falling down, flying up and all that, just kind of plodded higher, particularly since November of last year. And I referenced that because I know that was a real key date when we had a significant change in the government in the United States, and also the Pfizer vaccination was announced. So since then, the speculators really got long the Canadian dollar in size. We've talked before in the show about how the Canadian dollar is so highly correlated with commodities, and I really think that a lot of people saw buying the Canadian dollar was a play on the stock market. On the show, we previously talked also about what are the things that impact the Canadian dollar, and certainly at the top of the list, I suppose, is the relative strength or weakness of the U.S. dollar against all other currencies. You know, if the U.S. dollar is weak against most of the currencies of the world, it's probably also weak against the Canadian dollar. How the stock market is doing. I mean, the correlation between the Canadian dollar and the S&P 500 is very strong. So if the stock market's going up, the Canadian dollar's going up. And then you add in the commodity market going up, and it was like a three-bagger for the Canadian dollar to rise. And the speculators got to a point here at the beginning of June, or just around that time, where they had this very, very large speculative long position on the Canadian dollar. And then the U.S. dollar, started to strengthen against most currencies. And the Canadian dollar started to slip a little bit, and as it came off the first little bit there, the speculators added to their positions. In other words, they were buying the dip in the Canadian dollar. And then as the Canadian dollar continued to fall for the next, call it 2 months, they got their margin calls, and then they started blowing out their positions. So I think particularly once we dropped below 81 cents and came all the way down to about 78.5, the speculators really just said, okay, I'm out, and we had net selling from them and helped drive the Canada down. So Canada then has weakened, I think, very much because the U.S. dollar got stronger. It also weakened because speculators were too long the Canadian dollar and they blow out some of their positions. The Canada weakened even though the U.S. stock market generally went higher and commodities generally went higher. So, when you ask why did the Canadian do what it did, that's my answer. I've traded the Canadian dollar actually before it topped out. I thought this thing is goofy overvalued here. And so I was poking away at it. I got a good part of that move down on the Canadian dollar. And yet today here I was stopped out of a short position I had on the Canada. So right at the moment I have no position. I'll be looking to what those other components, the commodity market, the stock market, and the U.S. dollar are doing before I take a position in Canada again.
I see gasoline prices going up, and so does the price of crude. Do you think WTI will keep going up to $100 a barrel?
Well, you see gasoline prices going up. I know I fueled up my car the other day, and I thought, Jesus, this thing, what's it going to cost? I haven't paid that much to fill up my car in a while. WTI, let's see. It's had we remember in April of last year, WTI very briefly was trading at negative prices because there was more of it around than there was places to put it, and you can't just put crude oil on a shelf somewhere. It needs a storage facility, so we had those negative prices. But since then, it's really had a spectacular rally. Certainly, part of that, if not a big part of that, was OPEC and friends, as I call them, really cut back their production. It's trying to find some relative equilibrium or balance between supply and demand. So I think maybe they overdid it on the cutting back production side. Whatever, prices had a terrific rally until, let's say, the last month or so. We got up to close to $75 a barrel, and that seemed to be kind of the high watermark so far. Last week, I know crude dropped $7 and then rallied back $7, as kind of following the pattern of the stock market. Quick drop on Monday and then come back the rest of the week. OPEC has made plans here to increase production every month for the rest of the year. I think in total they're going to add about 2 million barrels a day to the supply. American production's coming back a bit, although it certainly hasn't had the gangbuster increases that we're used to the last couple of years. Iran's expected to be able to put some more oil on the market with coming to an agreement. Well, I don't even want to go there. I have no idea whether or not that'll happen, but that's a factor that's out there. So there seems, anyway, to be the prospect of greater supply coming into the market. Let's say for the last several months there's been a tightness in supply relative to demand. I'm going to think that tightness will probably go away. We might even find ourselves in a position where production is greater than demand. So, I don't see crude oil going to $100 a barrel, this year. It might go a bit higher here. I mean, I don't think, for instance, I just was telling you about, gassing up my car the other day. I don't think if the price of gasoline went up another 20 cents a gallon, I'm going to, ride my bicycle instead of going on my car. So what I mean by that is, a modest increase. We saw $80 crude. I don't think that's going to discipline demand very much. But, getting up toward $100 a barrel, I think there would probably be a real disciplining of demand. And then, whether or not the economies are there. So, yeah, I don't have a strong view on WTI. I mean, I don't see a fabulous trading opportunity at these levels. Other than, if we get some shivering and shaking in the pro-risk trade, in other words, stocks only go up, that sort of thing, I think crude could take a tumble. So if anything, the next thing I would do would be to short crude if it looked like it was going to have another break. We had, as I say, that $7 break from around the $75 barrel level. Came back pretty good, but if the market rolls over here now and goes down and trades below $70, I might be looking at it from the short side.
Before we wrap up, would you like to share some of your thoughts about your trading methods? One of the things I said there about you just can't know what's going on. You can't know everything. And actually, I think, I talked this over with my son so many times. I'd say there are people in the world that are trading exactly the same markets that we are, and we have no idea who they are. We don't know what their size is. We don't know what they know, how they're connected, whatever, what their time frame is. These are such major macro markets, then there's so many inputs to determine price that you just, if you buy something because you think X is going to happen and it goes up, it might not have gone up because of X. It might have gone up because of something totally other than what you were thinking about. I'm sort of long-winded getting around to it, but what I'm saying is my solution to that is I pay attention to how prices are changing more so than why I think prices are changing. Okay? In other words, the market's the market. Don't think I know what's going to happen. Just look at the market and say that's what is correct. Whether you feel as though it's outrageous or something doesn't matter. So I also look for what I call positioning vulnerabilities. I've described in the Canadian dollar in particular how the market had got all these people on the long side, and when the market started to roll over,
initially they bought the dip, as it were, and then when the market continued to go lower, all of a sudden all these guys are now sellers. I mean, that's just died and gone to heaven for me to find a position like that where, there's people that are phoning up, screaming at their broker to get me out, and I want to be there when they're trying to throw out things they don't want anymore. So many times we've talked about this, Jimmy. I think it's so important to determine your time frame. Before you put a trade on, while you're in the trade, and why you take it off. I know years ago I'd have these stories of somebody bought something and it didn't work out, and he still owns it, months or years later because he just couldn't bring himself to get out of it. And then finally you say, well, it can't go any lower. And of course it goes lower, and it's just awful. Where I'm going with that is the most important thing, one of the most important things in trading is to just never, ever take a big loss. Taking a small loss is not a big deal. Taking a loss on a trade means the trade is not working, and you're better off to be out of it. Don't be banging your fist on the table and yelling at the market. It's just, hey, I lose money a lot on trades. I think it's a cost of doing business. And if I think of it from the perspective of, I had no idea where this market was going to go. Okay, essentially nobody does. So if you picked, I think it's going to go up, and it goes down instead, no big deal. I mean, forgive yourself. You couldn't possibly have known that was going to happen, or you wouldn't have bought it. So I think managing the risk, and that's what you're trying to, when I say risk management, that's what you're trying to manage, is to make sure you never get clobbered on any particular trade, that you live to play another day. And that, losing money when you're wrong in a trade is just the cost of doing business, and you got to keep on keeping on.
Victor, thank you so much for chatting with us.
Jimmy, it's always a pleasure to talk with you and talk about markets. It's my passion, obviously. I've been trading markets for a long time, and I don't have any plans to quit.
My guest has been Victor Adair. Check out his website, victoradair.ca. If you have any questions for Victor or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.